I think it's a matter of time gold gets to $3,000 an ounce. It could meet the S&P 500 at that same level. It always has gone back to 1-to-1. And it's probably going to have some back and fill. I don't know how much lower it goes, but 2,200 is pretty good support. But the significance is gold has had a history of rallying when Treasury bond prices are rallying, meaning yields. So in terms of dollars. Now, if you're in a country that's debasing your currency, sure, gold's always going to be about currency debasement hedging. Gold has one key difference, is it is a store of value. And it's been breaking up for a while, and the deepest pockets on the planet are buying gold. Also, what just happened recently is that we've had a 2-year downtrend in ETF flows. It's just starting to turn upward. So one thing that's holding gold back right now, it's pressuring right now, is managed money futures positions are pretty stretched long for a bull market.
The gold price has risen past $2,500 for the first time in history, setting a new record and sparking new debates about safe haven assets in the digital age. Global tensions and economic instability have driven this rise, showing gold's appeal as a safe haven asset. Bitcoin is facing its biggest test yet. Currently valued at $53,540, Bitcoin has seen a 24% drop over the past week. The gold versus Bitcoin debate continues to shape investment strategies, and we're excited to see what follows. While the S&P 500 pared some of its losses, it suffered the biggest plunge in about 2 years, amid strong trading volume. According to Mike McGlone, if you look at the overlay of the 200-day moving averages for gold, Bitcoin, and the S&P 500, they are all heading straight up. However, he believes that only one will come out on top, expecting the 200-day moving average for Bitcoin and the S&P 500 to tilt lower, while gold will continue to rise. As macroeconomic conditions continue to deteriorate, gold prices are poised to reach new highs in 2024, with the potential to hit $3,000, according to Bloomberg Intelligence senior commodity strategist Mike McGlone. He has been predicting this for over a year. McGlone also explains the relationship between gold and U.S. Treasury yields, providing insights into why gold might emerge stronger in this environment. U.S. Treasury yields, which move inversely to prices, have declined sharply after weak manufacturing data and employment data released last week. A closely watched part of the U.S. Treasury yield curve, a key bond market indicator of an upcoming recession, turned positive for the first time in 2 years, as concerns grew that the U.S. economy is heading into a downturn. McGlone notes that gold often rallies when Treasury bond prices rise, making it a reliable hedge against currency devaluation. He sees gold and U.S. Treasury long bonds as the best-performing asset classes in the coming years as we approach a global recession. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
That's a key thing now. If you overlay like a 200-day moving average of gold, Bitcoin, and S&P 500, they're all heading straight up. And one of them's going to, I think only one's going to win out of that. And I fully expect 200-day moving averages to tilt lower and Bitcoin to tilt lower and S&P 500 as they tilt lower. But gold has one key difference, is it is a store of value. And it's been breaking up for a while, and the deepest pockets on the planet are buying gold. Also, what just happened recently is that we've had a 2-year downtrend in ETF flows. It's just starting to turn upward. So one thing that's holding gold back right now, it's pressuring right now, is managed money futures positions are pretty stretched long for a bull market. They're getting stopped out. It's one of those environments. It's not a want to sell. It's a got to sell. You sell what you can. And that's happening in gold and Bitcoin. But gold's going to come out of this ahead because as a percentage of compared to ETFs, and much more significant than futures were back in 2008 when gold went to 1,000, it dropped to 700, and then it started to move all the way up to 1,900. So I think this is a normal reaction, but the bigger picture problem is beta. It's a U.S. stock market, S&P 500. It's way overdue for maybe a bear market, a normal correction. And right now we're at the stage of a normal back and fill. When people say buy the dip, when markets, it hasn't even touched its 200-day moving average. And I just mentioned a few weeks ago, it was the most above its 100-week moving average in almost 2 decades, with the exception of the big money pump from COVID. So to me, normal reversion. Commodities predict this. The S&P, I'll end with this. The S&P, the Bloomberg Industrial Metals Spot Index was its peak earlier in there. It was up 24%. And it dropped to down on the year just a few weeks ago. It was telling you there's something wrong. I think it's a matter of time gold gets to $3,000 an ounce. It could meet the S&P 500 at that same level. It always has gone back to 1-to-1. And it's probably going to have some back and fill. I don't know how much lower it goes, but 2,200 is pretty good support. But the significance is gold has had a history of rallying when Treasury bond prices are rallying, meaning yields. So in terms of dollars, now, if you're in a country that's debasing your currency, sure, gold's always going to be about currency debasement hedging. But in this case, I think those are the two best potentially performing market asset classes in the next few years as we head towards this global recession, which is clearly the case in commodities, and that is gold and U.S. Treasury long bonds. So here's one thing I published recently, Jeremy. A few months ago, I pointed out, if you take the average of the top 5 countries in the world outside the U.S., including India, the average of their 10-year note yields just recently reached 100 basis points above the below the U.S. Treasuries. U.S. Treasuries were that high. Now the U.S. Treasuries are catching up. Typically, U.S. Treasuries yield a lot less than the rest of the world. And so to me, that's what's happening. That's why I think Treasuries are still the place to be, despite people talking about deficit spending. Now, that's a bit of a problem, but it's deflation and inflation that matters. And commodities, certainly industrial metals, are showing us clear deflationary forces. And if we just get more backup in beta, that's just normal deflation, reciprocal to significant inflation on the back of the biggest money pump in history to the peak in 2022.
McGlone draws comparisons between today's market conditions and the global financial crisis, suggesting this period could potentially be worse. He advises caution against buying the dip in equities, highlighting the importance of understanding the ongoing normal back and fill market corrections. Commodities from copper and gold to crude oil tumbled, while paring back some of the losses, as global economic malaise dimmed the outlook for industrial demand and sent traders rushing to cash out of profitable positions. Wall Street finished sharply lower on Monday, closing out a global market rout that saw Japan's main stock index suffer its worst day in 37 years. McGlone points out that commodities signal deflationary forces, as seen in the grain market, which has been heavily sold due to massive supply. Looking ahead, McGlone believes the best-performing assets in the next few years will be gold. Let's now turn our attention to the video again.
It's not so much what's driving the panic. This is normal mean reversion at the moment. The S&P 500 at about, as we speak, 5,200 is well above its 200-day moving average at 5,000. So there's still a lot of room for it to just catch up. It's just an example of what typically happens in markets is the most powerful force is mean reversion. Markets just got way too expensive. Then we saw kind of the plunge in the yen carry trade, the give back of all that liquidity there. But I think to me, the best leading indicators for all this has been Bitcoin. It trades 24/7. It's massive speculation, has very high volatility. It started breaking down on Saturday, then Sunday. It should have told you what's going on. But to me, this is just the beginning of a normal market correction. And when you hear everybody say buy the dip with the S&P 500 still well above its 200-day moving average, ignore them and let markets work. But we might have some short-term bounces. In fact, we should. The Fed is going to ease. I mean, they are way above the rates of inflation in this country. But to me, it's the macros I pointed out earlier. We have just a long-term example of risk assets getting way too expensive. Cryptos were a good example of that. I think gold's going to come out ahead. Now, it's getting a little bit hit today, but it did begin in 2008. But there's some key differences that I think are more supportive for gold this time than last time. Market pumped up to the peak in 2022 and then fell to where it is now. It was a commodity market. Now we're switching back to a market of individual commodities. And crude oil was a great example. What drives these futures markets are speculative futures. Managed money net positions in futures are good indicators. So petroleum futures got way too long at that peak early in the year in the 80s, and then got sold out completely as we flushed down to 69 or so in WTI. So they're basically sold out. So crude oil is basically somewhat flat in terms of managed money net positions. But what the key thing was this year was copper. That copper high, $5.20, was almost completely driven by pretty significant massive buying in speculative futures. They got to the highest level in about 4 or 5 years as a percentage of open interest, over 32%, and that's CME and LME, and now they're still getting flushed out. But the problem is, typically these bottoms in copper come when the positions get flushed out to maybe 5% open interest, and there's still 20% of open net long, so they're getting stopped out. And so that's where you really see that. You definitely see it in the grains. The grains are the best leading indicator because they have the highest elasticity supply and prices. And the grains have been way sold out all year. Massive short positions. Why? Because it's in a significant bear market. Why? Because there's massive supply. And the main reason was because of the big pumps in prices. So it's that autocorrelation factor that's kicking in commodities. You can see that in managed money net positions. It's trickling down the equities now. And the bottom line is commodities are showing us deflation. Cryptos, I think, are signaling there might be more of that. And if we just have a little bit of more back and fill in the stock market, that's pretty severe deflation that is pretty much overdue if you look at the lessons of history. I think there's times to be underweight risk assets and overweight risk off assets. And I think in the next few years, some of the best performing assets will be gold and U.S. Treasury long bonds as we tilt towards a deflationary period reciprocal to inflation that we got to the peak in 2022. It's happening globally. Keep an eye on China. It's happening in Europe. We see issues in Canada. The question is what stops at this juncture. We will see cuts in U.S. interest rates, and they're still pretty high. But I'll end with this. The U.S. unemployment rate, it's 4.2 or 4.3%, bottom last year at 3.4%. It's never bottomed that low without going to 6%. And that's just 100% probability since 1947. I suspect that might work. Let's see how different it is this time.
Gold's price is rising, while Bitcoin faces scrutiny. This is because gold is strong, and Bitcoin is changing. Gold is expected to remain under pressure due to a strong U.S. dollar and rising Treasury yields, while geopolitical tensions and anticipated Federal Reserve rate cuts offer some support. They have also pressured gold to become a safe haven asset. We want to hear from you. Feel free to leave your thoughts in the comments. Give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.